and welcome to One Big Beautiful Bill, Private Client and International Planning Provisions. We're so thankful to have you here to join us here today. My name is Jennifer McNeil-Lozano. I'm the co-chair of the BHBA's Trust and Estate section. Before we begin, I'd like to take a moment to thank our sponsors. The Trust and Estate section is sponsored by Bond Services of California, Liberty Mutual Surety, California Title Company, Pickford Escrow Company, and the Sanborn team. Nancy and Brian, please say hello.
Hi, everyone. So we thought we would take this moment to give a quick real estate update since nothing as exciting has happened in the probate world. Recently, I'm sorry, you'll have to forgive my voice, we've been noticing the properties are staying on the market longer. When it comes to probate and trust properties, setting the right price from the start is key. These homes are usually sold as is. Unfortunately, sometimes with tenants in place or maybe another major problem that we do not want the estate to fix. A correct price attracts the right buyer and brings real interest right away. It also helps avoid long-time market time. Long-time market time creates doubt and sows like, why is it on the market so long? So anyway.
What Nancy and I bring is clear direction, deep market knowledge, and over 3 decades of skill with probate and trust sales. We guide your clients through every part of the process so they can make safe and smart choices. With the right price and the right plan, we create real market energy, and we give the estate the best chance for a smooth and successful sale.
So one of the adages we say we've learned over time, we can't change the location of a property if it's not selling. The only thing that we can actually change is the price. All right, guys, have a good meeting. Enjoy this big, beautiful bill.
Thank you, Nancy and Brian. Now I'd like to turn things over to Leah Momcios to provide this month's legal updates. Leah?
Thank you, Jennifer. So breaking news, California is reinstituting an asset test for Medi-Cal programs effective January 1st, 2026. Medi-Cal is California's implementation of Medicaid. Starting on January 1st, 2024, California Medi-Cal did away with the asset test for Medi-Cal program eligibility purposes. That includes long-term care. However, after only 2 years of no asset tests, as of January 1st of next year, California will revert to a limit of $130,000 in assets per individual, plus $65,000 for each additional household member. This is an increase compared to the asset limits in place prior to 2022, which were only $2,000 in assets for single applicants and $3,000 for couples. So traditionally non-countable assets like the primary residence and one vehicle, for example, will remain non-countable for eligibility purposes. Now, with respect to the applicable ineligibility penalty period due to disqualifying asset transfers, DHCS has indicated it'll issue guidance at a later date. The current look-back period applies a penalty only to transfers before January 1st, 2024. But for those who applied before January 1st, 2024, the ineligibility period looked back 30 months prior to the application date. So it'll be interesting to see where DHCS lands. And current Medi-Cal enrollees and those applying before January 1st of next year will need to comply with the reinstated asset limits by the date of their next annual redetermination process. But after January 1st of 2026, new Medi-Cal applicants have to comply with the reinstated asset limits as part of the application process. So the reason for this change, common theme, a slow California economy coupled with larger than expected Medi-Cal enrollment has led to budget shortfalls. And other Medi-Cal changes include freezing enrollment for adults 19 years or older without, quote, satisfactory immigration status. And that's your legal update for this month.
Thanks so much, Leah. Now, on to the program. Today's speakers are Alan Whitland and Robert Berkson. Alan Whitland is a partner in the private client and tax team at Withers Bergman LLP, advising U.S. and cross-border clients on tax planning for corporations, partnerships, individuals, and tax-exempt organizations. He counsels clients on entity structuring, real estate and crypto investments, and intra-family wealth transfers, as well as relocation and multi-jurisdictional tax matters. Before joining Withers, Alan provided tax advisory and compliance services at leading accounting firms. Robert Berkson is a senior associate in the private client and tax team at Withers Bergman LLP, focusing on domestic and international tax matters. He advises businesses and their owners on tax planning, entity selection, and structuring tax-efficient transactions for startups, multinational corporations, and high net worth individuals. Before joining Withers, he provided tax consulting and compliance services at a top accounting firm. Please welcome Alan Whitland and Robert Berkson.
Alan, you are muted.
Hi, Ellen. It looks like you're muted.
I am. We are how many years post-pandemic, and I've yet to figure that out. Appreciate everyone's patience with that. What I was trying to say was that I was thankful for the nice introduction and the fact that you were willing to have us talk tax a bit with you guys today. I don't want to undersell the program by any means, but I think for those of you that were practicing in 1986 and certainly in 2017, those were significant tax acts that came in and changed the landscape of what everyone knew and had been doing previously. With the most recent, with the Tax Cuts and Job Act in 2017, TCJA, there were significant changes. There was the introduction of GILTI. There was transition tax with 965. There was the introduction of 199 Cap A. There was opportunity zones. There was changes to rates and things like that. What we'll be talking about today does not have kind of all those changes. A lot of it is extensions of what was already in place, but was set to sunset under the previous rules. And so you'll just have to bear with us as we go over the changes that did take place, as minimal as they may be. So I'll apologize in advance and thank you for bearing with us as we go through kind of a rules intensive, but not necessarily massive change to the tax provisions. So with that, I guess now that I've successfully undersold it, we will kick off here. So how did we get here? The Tax Cuts and Job Act, if we can go to the next slide. The Tax Cuts and Job Act, most of the provisions, as I mentioned, were set to expire very soon, January 1st, 2026. This was going to create a significant tax increase and a reduction of the estate tax exemption down to about $7 million for individuals and $14 million for married couples. The original version of the One Big Beautiful Bill Act, that's OB3, as I will refer to it throughout the course of this presentation, it passed the House by just a single vote back on May 22nd. So that was 215 to 214. It then made its way through the Senate, which took it up and passed its own version of it with some different changes. There was a lot of kind of horse trading and back and forth. And that was passed on July 1st, again by a single vote. In this case, it was deadlocked, and Vice President Vance had to act as the tiebreaker in order to pass it. The House then needed to pass that version, which it did so on July 3rd before President Trump's kind of deadline of July 4th. It was done in an all-night session. Ultimately, the voting was 218 to 214, and President Trump signed the bill into law on July 4th. Next slide, please. So given the group that we're talking to, we'll start with transfer taxes or estate taxes. So starting in January 1st, 2026, the estate tax exemption is permanently increased to $15 million for individuals, $30 million per married couple. That includes portability. That number will also be adjusted for inflation annually. I think importantly here, while people were gearing up for this to go away, there was a lot of end-of-year planning that was probably being put in place for 2025. That's kind of no longer necessary at the moment. There's going to be at least a few years of this higher estate tax exemption. which will allow people to get their plans in place or figure out what they need to in order to make use of that. It might be, it's permanent, but permanent only means until the next tax bill or the next administration changes something. So that's where we stand with the estate tax. The generation skipping transfer tax exemption, that applies to transfers to individuals more than one generation below the donor. That's mainly grandchildren. It's permanently been aligned to move in lockstep with the estate tax exemption. Each individual donor must elect to apply this exemption separately because there is no portability between spouses. The annual exclusion for gifts, that remains as it is, $19,000 for 2025. That continues to be adjusted for inflation over time. So multi-generational planning strategies using dynasty trusts could be even more effective than before because there's no risk in the reduction or clawback. It's a good time, since there is not the rush, it's a good time to reevaluate estate plans and ensure that clients are taking full advantage of the various exemptions that are available to them. It should be noted that the estate and gift tax brackets, those stay the same. So it's going to be a maximum rate of 40%. So once you're in that area of a taxable estate, you're looking at 40%. Next slide, please. So in addition to the changes to the sunsetting estate tax, the income tax rates were set to sunset and increase significantly. The lower rates that were put in place by TCJA were made permanent. So that's 37% on income over $626,350 for single and head of household filers, $751,600 for married filing jointly. It goes down to 35% for income over $250,000 for singles, roughly, and $500,000 for married filing jointly, 32% for $197,000 for singles, and $394,000 for married filing jointly. These numbers change annually based on inflation. So the increased standard deduction was made permanent as well, with inflation adjustments going forward. Currently, for this year, that's $15,750 for singles and $31,500 from married filers. The personal exemption remains repealed, and there's a bonus deduction for seniors age 65 or older. That's a $6,000 deduction that's been phased out for $75,000 for single filers and $150,000 for married filers. Next slide. So the charitable contribution deduction for 2026 and going forward, itemizers can deduct. This was actually a somewhat meaningful change. Itemizers can deduct charitable contributions only to the extent that they exceed a threshold amount of 0.5% of their contribution base. That's essentially their AGI, excluding personal NOLs. Carry forwards are only allowed if the 0.5% requirement is met. The AGI limit of 60% for cash gifts to public charities has been kept in place. Non-itemizers can deduct contributions of up to $1,000 for single filers and $2,000 for joint filers. One of the I don't know how significant it is in terms of tax overall, but in terms of changes that were made, President Trump, on the course of the campaign trail, talked about no tax on tips. That, in fact, was implemented, although with a lot more rules in place than I think the slogan leads to. So, no tax on tips. It's taken as a $1 for $1 deduction from income, but rather than having that be on all tips, the Senate capped the deduction at $25,000. The benefit phases out for individuals with income higher than $150,000 and for couples with income over $300,000. That's true for tax years 2025 through 2028. Tipped workers will still pay state taxes and local income tax and payroll taxes on their tipped income. I'm not quite sure how that will be tracked, and I wish all the various CPAs who work with tipped employees well as they kind of work through that, because I'm not sure the employees themselves will be remembering to track everything quite so closely, given the headline of no tax on tips. There was also no tax on overtime that was put into place. A deduction for qualified overtime pay of up to $12,500 for singles, $25,000 for married filing jointly, and that's for tax years 2025 through 2028. A phase out begins at AGI of $150,000 for singles and $300,000 for married filing jointly. There's also a Social Security tax reduction. Individuals age 65 and older claim a $6,000 deduction from 2025 through 2028. That again was kind of a campaign promise that came to fruition. Next slide. Another thing that was talked about was an automobile loan interest deduction of up to $10,000 in 2026 through 2029. That ability to deduct interest is for purchased automobiles that were assembled in the United States. There is actually some confusion about what assembled in the United States means and how much has to be assembled. I believe that is still being worked out, but it's completely phased out at $150,000 for single filers and $250,000 for married filing jointly. And the VIN number is used to establish the origins of the car at issue and whether it meets the assembled in the US test. Another change, and this was depending on where you are in the country, either viewed favorably or not, was some of the clean energy tax credits that were put in place under the 2022 Inflation Reduction Act. That gave you credits for heat pumps and for solar and batteries and things of that nature, as well as home EV charging and electric vehicles themselves, tax credits that were being taken advantage and really boosting sales in those areas. So a lot of those were taken away. Some went out in September. Some you were able to take advantage through the end of the year. So for the September, you might have seen a lot of car commercials that were really, really pushing that. But here we are, and the credits are about a month away from going away entirely. The child tax credit, the current $2,000 child tax credit was set to return to $1,000 in 2026. Again, another expiring TCJA number. It is now permanently increased to $2,200 with adjustments for inflation and phase outs for higher earners. This number was pretty hotly contested. It was one of those things that changed from the House bill to the Senate bill, and it ended up $300 beneath what the initial House version that was passed back in May of $2,500. Miscellaneous itemized deductions were permanently suspended, and the benefit of itemized deductions for individuals in the 37% bracket were now limited to 35%, with an effective rate with SALT further reduced to 32%. So again, hopefully the tax software is in place, because tracking all of that and what's limited and how it's calculated has just become a bit more difficult. Robert, over to you.
Thank you, Alan. So the next slide regarding state and local taxes, what's shown is primarily respecting the pass-through entity tax election. But before getting there, I think some good news for us in California and other high tax states is with respect to the increase in the state and local tax deduction. So the applicable limitation on the federal tax deduction for state and local taxes, you can think your California income tax or your property tax is raised from $10,000 to $40,000 for those married filing jointly, or alternatively from $5,000 to $20,000 for those married filing separately. So the increase in the SALT deduction to $40,000 is certainly a meaningful amount. What's nice about that is that it's also set to increase 1% by each year. So for example, in 2025, it's $40,000. 2026, it'll be $40,400. And what's interesting is a lot of these rate changes or amount changes are set to sunset. So for example, that $10,000 cap which is the law pre-OB3, is set to return in 2030. And likewise, a lot of the campaign promises that Alan had mentioned, whether it be no tax on tips, no tax on overtime, those also are slated to expire at the end of 2028. And with respect to the SALT deduction, again, that $40,000 limit or the 40,000 cap is the same for single and married couples. As a mechanism or a workaround of being limited with respect to the SALT deduction, many states created a pass-through entity tax election to mitigate the federal SALT cap. And the workarounds basically allow pass-through entities to pay state taxes at an entity level and thus avoid the SALT cap, whatever the amount might be. Irrespective of the OB3 changes to the SALT deduction, it appears that these pass-through entity elections, they're still a viable option, and you can still use them as a workaround. It's just with the increase now in the SALT deduction, it's important to watch and manage your credits to ensure that you can fully utilize them. Next slide, please. QSBS. So Section 1202, I think these changes made the VC funds in Silicon Valley very happy, and they seemingly came out of nowhere. So QSBS is the tax benefit intended to incentivize investments in small businesses and specifically in corporations. The changes that we'll get into on the next slide are effective after July 5th, 2025. So that's an important date to watch out for. So with respect to the QSBS changes, there was an increase in the lifetime cap from $10 million to $15 million, and that will be indexed for inflation. And more importantly, though, there's a tiered holding period now to qualify for the exclusion. Previously, the $10 million or 10 times your basis exclusion was specifically limited to taxpayers or shareholders who held their shares in a qualified small business for 5 years or longer. Now, there's a tiered holding period where you can still qualify for the exclusion. For example, you can hold your shares for 3 years or longer. You're eligible for a 50% exclusion, 4 years, 75%, and then 5 years, that golden sort of holding period for 100% exclusion. Additionally, and seemingly very helpful to many businesses, was expanded eligibility, and specifically the aggregate gross asset test for measuring whether or not your shares were issued from a corporation at a time when it was considered a qualified small business has increased from $50 million to $75 million. So the result is that many startups that otherwise have greater than $50 million of aggregate gross assets, but less than 75 can now qualify as a qualified small business. Next slide, please.
Okay, Robert, before you get to the next slide, it might bear repeating the date of applicability, because I know certainly in our practice, we've gotten a lot of questions about, well, now that these rules have changed, the stock I got 2 years ago, that'll have different rules. So if you can kind of explain that a bit more, I think it'd be useful.
Yeah, very good point. So unfortunately, those rules would apply, the new rules apply only to stock that is issued, post July 4th or post July 5th. Basically, what that means is even if you were issued shares, let's say on January 1st, 2025, you are limited to that $10 million or 10 times your basis exclusion amount. Whereas anything, we'll say post July 4th, if you were issued shares in a qualified small business immediately before and immediately after that issuance, you are eligible for that expanded or greater $15 million exclusion cap. And with that, there are various planning opportunities available. A common planning technique is stacking or spreading your QBS benefits. In effect, how that works is a gift of your shares to a non-grantor trust. Again, it can't be a grantor trust such that you would be viewed as, the same taxpayer. It has to be a gift to a separate taxpayer. And basically what you're able to do is to maximize or to stack that QSBS benefit across, multiple taxpayers. It's in doing so, it's important basically to avoid what might be considered abusive structuring. And so your trusts actually have to have true economic substance and independence. And in addition, one other perhaps planning opportunity is in relation to the new $75 million aggregate gross asset test. For example, if you're operating as an LLC or frankly a partnership would not be eligible for QSBS benefits. The company has to be a C corporation, but what you can do is convert your single member LC or partnership to a corporation before you meet that $75 million aggregate gross asset threshold. And in doing so, you're able to take advantage of the 10 times basis exclusion benefit. Next slide, please. 199 cap A. This is the 20% deduction for qualified business income that's generally going to come from your pass-through entities, whether it be a partnership, S corporation, LLC, etc. And 199 cap A was initially a deduction that was implemented as part of the TCJA, and it was intended to provide those shareholders or partners and pass-through entities with a similar rate deduction benefit in line with the reduction of the corporate tax rate from 35% to 21%. So the QBI deduction it's available regardless of whether taxpayers itemize or take their standard deduction. And the OB3 made it permanent. Next slide, please. So while there are certain phase in and phase out amounts for taxpayers, specifically for the 2025 year, the 20% QBI deduction for an SSTB, an SSTB being a certain trader business that is a specified service trader business that is actually not eligible for the deduction. But again, for 2025, the QBI deduction for SSTBs actually begins to phase out when taxable income exceeds $394,600 for those filing jointly. Then no deduction is allowed for an SSTB when taxable income reaches $494,600. For non-SSTBs with income above the threshold, the 20% QBI deduction is modified based on wages paid in a certain cost basis acquisition formula. Now, the OB3 expanded the phase-in range for married filing jointly couples from $100,000 to $150,000. And as a result, the 2026 phase-out range increases from $394,600 to $494,600, to $394,600 to $544,600, and that's for both SSTBs and non-STBs. So if a married couple filing jointly has taxable income above $544,600, no QPI deduction is allowed, period, for any income from an SSTB. And for businesses that are not SSTBs, if the income exceeds that limit, the deduction is subject to limitations, again, based on wages paid in acquisition costs for qualified property.
Okay, so now we can talk about the expensing of domestic research and experimental expenditures, the R&D expenses. So prior to 2022, businesses deducted R&D expenses in the year incurred. TCJA required R&D expenses to be treated as an asset or capitalized and deducted over 5 years. That'd be for domestic R&D, 15 years for foreign R&D. Under the OB3, notwithstanding Section 263, you are allowed to take as a deduction any domestic research or experimental expenditures that are paid or incurred by the taxpayer during the taxable year. The term domestic research or expenditure means research or experimental expenditures paid or incurred by the taxpayer in connection with the taxpayer's trade or business, other than such expenditures that are attributable to foreign research. That's defined within Section 41D4F for those keeping track at home. Except as otherwise provided, the amendments made by the section, they apply to amounts paid or incurred in taxable years beginning after December 31st, 2024. Small business taxpayers with average annual gross receipts of $31 million or less generally will be permitted to apply this change retroactively to tax years beginning after December 31st, 2021. All taxpayers that made domestic research or experimental expenditures after December 31st, 2021 and before January 1st, 2025 can elect to accelerate the remaining deduction for those expenditures over a 1 or 2 year period. The law change allows for small businesses to apply the change retroactively to 2022 when capitalization and amortization requirements first began. All other businesses can accelerate the remaining R&D amortization deductions over 1 or 2 years. At the election of the taxpayer, in the case of a domestic research or experimental expenditure, the taxpayer is able to charge such expenditures to capital accounts and be allowed an amortization deduction of such expenditure ratably over the period of not less than 60 months, as may be selected by the taxpayer. The election made for any taxable year, but only if not later than the time prescribed by law. That includes extension. So basically, you need to get this on your timely filed return, including the extension. The method, if elected, and the period selected by the taxpayer needs to be adhered to in computing taxable income for the taxable year in which the election is made and for all subsequent taxable years. This is with the approval of the IRS. You can make a change to a different method, which is authorized with respect to part or all of the expenditures. Again, all of these tax changes are benefiting our CPA and compliance friends, as there's just that much more to keep track of. The section does not apply to any expenditures for the acquisition or improvement of land or the acquisition or improvement of property to be used in connection with the research or experimentation of a character, which is subject to the allowance under Section 167 or Section 611. It does not apply to any expenditures paid or incurred for the purpose of ascertaining the existence, location, extent, or quality of any deposit of ore or other mineral. So you have to look out for what exactly the expenditures are being used for. For purposes of this section, any amount paid or incurred in connection with the development of any software shall be treated as research or experimental expenditure. 15-year amortization period in the case of specified research or experimental expenditures, which are attributable to foreign research. See, as promised, the person controlling the the deck was excited to get to the Trump accounts and off of expenditures because it is quite dry. And I apologize for that. So Trump accounts. This is an interesting one. So this is the OB3 creates Trump accounts, which that is what they're called, a new kind of saving account designed to incentivize education, entrepreneurship, and home ownership while promoting financial security. They're administered by a bank or similar financial institution, and the overall program is overseen by the Treasury. Starting January 1st, 2026, parents of any child under the age of 8 years old may open a Trump account for their child. The accounts are eligible to receive contribution from parents, relatives, and other taxable entities, as well as nonprofits and government entities facilitated by the Treasury Department. To be eligible to open a Trump account, the child must be a U.S. citizen, and at least one parent must provide their Social Security number. The Social Security number provided must be considered work eligible in order to open an account. The Trump account funds themselves need to be invested in a diversified fund that tracks an established index of U.S. equities. So taxable entities can then contribute up to $5,000, that'll be indexed for inflation, of after-tax dollars into a Trump account. Employers can contribute to Trump accounts on behalf of their employees up to $2,500 if they have a Trump account contribution program. These employer contributions are not included in gross income, so there's a tax benefit there. Contributions provided to Trump accounts from tax-exempt entities such as private foundations are not subject to the $5,000 annual limit, meaning you can get greater. And contributions from unrelated third parties must be provided to all children within a qualified group. That would be all children in a state or a specific school district or educational institution. So when an entity is giving these kind of amounts, they have to define their group in a way that they ensure that they're giving to all of the people within that defined group. No additional contributions can be made to Trump accounts after the beneficiary has attained the age of 18. Distributions from Trump accounts, and this is where it gets a bit interesting, they cannot be made before the beneficiary reaches the age of 18. So once the money is in there, it has to stay in there until the beneficiary reaches the age of majority. A distribution that returns the original contribution to the Trump account is not subject to tax, so essentially the principal. Earnings or investment gains within the Trump account are taxable to the beneficiary, regardless of how the funds are used. So that means that any kind of growth will be taxed at that point, even if it's put to educational uses, which might then raise questions as to what this is actually doing and why someone would prefer this as opposed to a 529 plan. And that is something I have myself pondered. But I think we'll get to the one potential perk here in just a moment. The OB3 created a pilot program for Trump accounts. So for U.S. citizens born between 2025 and 2028, just that specific period, the federal government will actually contribute $1,000 per child into every eligible Trump account. For newborns, Trump accounts may be opened by parents or guardians. To be eligible to open a Trump account and receive the $1,000 contribution, the child must be a U.S. citizen, and unlike just the opening of a normal Trump account, both parents must provide their Social Security numbers. These Social Security numbers must be considered work eligible in order to claim the credit. If the Treasury determines that an eligible individual does not have a Trump account open for them by their first tax return when the child is claimed as a qualifying child, the Treasury will actually open an account on the child's behalf, taking into account, to the extent possible, the parent's preferred custodian and investment fund. Parents do, in fact, have the option to opt out of the account, so if that is something they want. Again, going back to this, and it's noted here on the slide, a 529 plan or other educational fund often has greater advantages. It can grow tax-free, and then if used for the educational usages, it won't ever be taxed. But opening this Trump account for a child who's eligible within that 3-year period certainly can get you that $1,000, which is a benefit that is kind of hard to say no to. Okay, next slide. So opportunity zones. This was a major topic of conversation, at least in the tax world, at the passage of TCJA in LA, in the real estate development heavy LA. It was often talked about. So under prior law, opportunity zones existed as a temporary policy that had been used as an economic development tool to revitalize distressed communities across the country. As mentioned, it was created in TCJA, and opportunity zones are census tracts that meet the definition of low-income community, and which were nominated by state governors and certified in the U.S. Treasury as eligible for qualified investments to be made in exchange for certain tax benefits. The program was created as a temporary policy, existing over a 10-year window as an initial round of opportunity zone development. Like a lot of TCJA, it was then set to expire. But it has been brought back to life by OB3. So low income, here's some definitions that are relevant here. The low income community is a census tract that has a poverty rate of at least 20% or a median family income that does not exceed 80% of the area median income. A qualified opportunity fund is an investment vehicle with the specific purpose of investing in opportunity zones. All qualifying investments must be made through qualified opportunity funds in order to be eligible for the tax benefits. In each state, governors were able to nominate up to 25% of eligible tracts as opportunity zones. If a state had less than 100 eligible tracts, then up to 25% of tracts were allowed to be designated. Additionally, under certain circumstances, a contiguous tract that was not a low-income community was able to be designated along with the low-income community that was designated as an opportunity zone. So if you can go to the next slide. The Opportunity Zone program operates over a 10-year window and provides investors with 3 tax benefits for investing their unrealized capital gains into eligible distressed communities. So first, it provides a temporary deferral of taxes for capital gains rolled over from a non-opportunity zone investment into a qualified opportunity fund to be invested into an opportunity zone. The taxes are not realized until 2026 or when the asset is sold or disposed of, whichever comes first. It also provided a step up in basis in their previously earned capital gains, which were invested in an opportunity fund. Investments held for 5 years received a 10-year step up in basis, 7 years an additional 5%, for a total of 15%. And the real kind of plum here was that for investments held for at least 10 years, taxpayers received a permanent exclusion of taxable income on the gains resulting from the original investment that was essentially rolled over into the opportunity fund. The initial opportunity zone round was set to expire after December 31st, 2026. So again, OB3 created a second round of opportunity zones. Specifically, it narrowed the low-income community definition to census tracts that have poverty rates of at least 20% or a median family income that does not exceed 70% of the area modern median income. The term low-income community does not include any census tract where the median family income is 125% or greater of the area median family income. That provision maintains that the opportunity zone designation process from the TCJA and adds that at least 33% of designated opportunity zones must be comprised entirely of a rural area. In the case that there are fewer than 33% of rural qualified opportunity zones, all eligible rural areas must be designated. So the rural area is defined in the Consolidated Farm and Rural Development Act. This provision made contiguous tracts ineligible for opportunity zone designation. Further, the provision simplifies the investment incentives and creates rural qualified opportunity funds. That gives certain benefits to rural qualified opportunity funds rather than the normal ones. Taxpayers can choose to invest up to $10,000 of post-tax ordinary income into an opportunity fund or a qualified opportunity fund, and a special rule is created that lowers the substantial improvement threshold that was set in place initially of existing structures from 100% to 50% in rural areas. For those that have worked in opportunity zones previously, they're very rule intensive, as you can tell. Other than just extending the opportunity zones, they really try to benefit rural areas and farm areas by making the rules somewhat simpler and giving more benefits for people who choose to invest within those areas. All right, next slide.
All right, the endowment tax. So the changes to the endowment tax really reflect changes to the definition of net investment income. And additionally, there's now a graduated rate that applies. So specifically, the OB3 expanded increased the existing 1.4% endowment tax and exposure for private educational institutions, and particularly those with federally supported R&D or affiliated private foundations or supporting organizations. And now as instead of a 1.4, flat endowment tax, there's graduated tax of up to 8% on quote unquote net investment income of applicable universities that have at least the equivalent of 3,000 full-time tuition paying students as of the preceding tax year with an endowment of at least $500,000 per student. Part-time students are counted on a pro rata basis. The affected institutions, primarily your private colleges, they have at least 50% of the students located within the US, and they're not state colleges or universities. And the various brackets and the rates that will apply now, $500,000 to $750,000 of net investment income, subject to that 1.4% tax, $750,000 and above to $2 million, subject to 4%, and then above $2 million, 8%. The Treasury Department has been directed to implement regs, sort of interpreting the act, but specifically to prevent avoidance of the tax. And so, as mentioned, the primary changes to the definition of net investment income specifically include federally subsidized royalty income, which is royalty proceeds of any patent, copyright, or intellectual property if the income results from the work of students or faculty, and federal funds were used in the research, development, and creation of that royalty-producing asset. If a post-secondary institution makes institutional loans available to its students, then any interest earned on those loans is also now included in investment income. And finally, investment income of any related organization will also be included if the organization controls or is controlled by the post-secondary institution, or is controlled by one or more individuals who also control the institution. Alternatively, or is a supported organization or a similar organization for the benefit of the institution. Amounts won't be double counted, and assets and net investment income are intended for or available to the institution, unless the organization is controlled by the institution or by a supported organization. The federal remittance tax on funds wired outside of the U.S. Was actually a new provision added by OB3, somewhat controversial. In theory, the intent is to prevent money laundering and terrorist financing with respect to outbound transfers of cash from the U.S. However, there's perhaps political motives in essentially implementing an excise tax basically on outbound transfers of cash, perhaps to family members abroad. So specifically, the new statute 4475, U.S. citizens, green card holders, and non-citizens wiring funds outside of the U.S. are going to incur a 1% excise tax on qualifying cross-border transfers beginning January 1st, 2026. The tax is based on the amount transferred, and it will only apply to remittance transfers for which the sender provides cash or a money order or a cashier's check. you can think of, for example, remittances made by credit unions, Western Union, specifically a qualifying transfer that's going to be subject to the tax is limited to transfers initiated by an individual, mainly for personal, family, or household purposes. Commercial transactions, importantly, are not covered. While the sender is required to pay the tax, it's the remittance transfer provider, or the RTB, who must collect it at the time and then eventually remit it to the IRS quarterly, similar to employment taxes. Next slide, please. So again, this is somewhat of a controversial statute now because it doesn't define or further distinguish between cash versus non-cash transfers. And cash usually refers to flat currency, leaving potential question with respect to cryptocurrencies. And there was a proposed credit for the tax, but was removed before the final passage, and there's currently no deduction for that tax, so non-deductible. Its intent is effectively number one, to improve transparency and again to thwart money laundering and terrorist financing, but it's also a revenue raiser, $10 billion over 10 years. Again, unfortunately, because there's no deduction, it'll potentially result in double taxation, as well as costly record keeping for taxpayers and those financial institutions, and will burden families and communities that frankly rely on the remittances. Again, debate continues over potential exemptions, enforcement challenges, and whether or not the tax should be, a permanent fixture in the code. There are some important exceptions, and mainly those the excise tax won't apply if the transferred funds are withdrawn from an account that's held at a institution subject to the Bank Secrecy Act, which includes most U.S. banks and credit unions, alternatively U.S. brokers or U.S. agencies, or a U.S. branch of a foreign bank subject to the Bank Secrecy Act. Alternatively, it won't apply if the transfer is funded through a U.S. issued debit or credit card. Now, those remittance transfer providers that don't fall under that exception include businesses such as money transfer operators, digital payment providers, and check cashing businesses and convenience stores. And finally, there are anti-conduit regulations that will apply. Multi-party financing transactions that can be recharacterized by disregarding the participation of intermediate entities when participation is pursuant to a tax avoidance plan.
See, we're running a bit low on time, so I'll try and speed things up. So talking about bonus depreciation. Bonus depreciation allows for businesses to immediately deduct a substantial percentage of all of the purchase price of eligible assets in the year they're placed into service, rather than spreading the deduction over the asset's useful life, as is typical. The accelerated depreciation is designed to encourage investment by improving cash flow and reducing tax liability. Under pre-OB3 law, the 100% allowance was phased down by 20% per calendar year for qualified property acquired after September 27, 2017, and placed into service after December 31st, 2022. OB3 made the 100% bonus depreciation permanent. So this change applies to property acquired after January 19th, 2025. I'm sure there was a reason for how that date was chosen, but if someone were to purchase equipment, say on January 18th, that would fall under the old rules, while something that was acquired on January 20th gets this bonus depreciation. Again, kind of complicating matters, and I'm sure a trap for the unwary for someone out there. A separate first-year depreciation measure under Section 179 was expanded to provide a deduction of up to 2.5 million for qualifying property placed into service during the tax year. That's available after December 31st, 2024. The maximum deduction limit is reduced for qualifying property purchases that exceed $4 million, and these amounts will be adjusted for inflation after 2025. So next slide. The last thing I will talk about is the restoration of limitation on downward attribution. This is something that Robert and I have dealt with extensively, both in our prior lives at accounting firms and then here with Withers as well. Perhaps you've had clients that found themselves in a situation where, because of downward attribution, which was outlawed in pre-TCJA rules, but due to a kind of a fluke created as a problem by TCJA, an individual that might be a small shareholder in a foreign structure, if there's a U.S. entity somewhere down the chain, can create a world of where they own CFCs even though they're less than a 10% shareholder. It also creates CFCs owned by the lower tier U.S. corporation. It owns the entities that in fact own it, which was not the purpose of the rule. So when determining U.S. shareholders for CFC status, 958 applies. The constructive ownership rules of Section 318A with certain modifications. Section 318A3 provides rules for when corporations are considered to own stock owned by a shareholder. That's downward attribution. As mentioned, 2017 Act repealed 958B4, and this created the downward attribution problem. So following the repeal of that, lower tier domestic entities could cause foreign corporations in a multinational group to be treated as CFCs, even when no U.S. shareholder had direct or indirect interest in the foreign corporation. Next slide, please. So here's just a picture of it, if you can kind of follow along. Pre-TCJA, a foreign parent might own a U.S. subsidiary and might brother sister to that U.S. subsidiary own a foreign affiliate. Post-TCJA, for income tax reporting purposes, it would actually look like this. The U.S. sub would own the foreign affiliate as well, and it would have to file a 5471. This was missed a tremendous amount of times and kept a lot of people busy doing streamlined submissions and the like once this problem was caught. It wasn't just a problem for the U.S. subsidiary, though. It was also a problem for the U.S. shareholders, again, even if they were not usual CFC holders in foreign parent, for example. Next slide. So the Act, OB3, primarily puts in place the limitation on downward attribution that was removed by the 2017 Act. Rather than just putting it back, which was, I think, up for discussion immediately following TCJ's implementation, because everyone realized it was kind of a mistake, they decided to put in 951B. It essentially fixes the problem, but it also creates this smaller concept of foreign-controlled U.S. shareholders and foreign-controlled corporations, as opposed to just typical CFCs. It's an FCFC. I will also tell you that I've read, I don't know, 6 or more articles on this particular subject, and each article interpreted all of this differently. They all agree that it fixes the downward attribution problem, but it's unclear whether it creates additional new problems, especially with regard to some foreign trusts that might own interest in foreign accounts, foreign companies. So it's definitely something to keep on your radar and be aware of whenever you're dealing with shareholders of non-US companies. Next slide. So here's an example that I guess you can peruse on your own time that compares the two situations pre-OB3 and then post-OB3. It impacts the foreign tax credit. I think it would be a little difficult to go through at the moment, but definitely worth taking a look at. Next slide.
So I know we're running out of time here, so I will quickly get through the next few slides. But the next 3 slides, GILTI, FDII, and BEAT, are all TCJA provisions, and the main changes are rate changes. With respect to GILTI, Global Intangible Low Tax Income, now has a new name, Net CFC Tested Income. We are doing away with quote unquote intangible income because the reality is that GILTI is intended to be sort of a catch-all and subject the U.S. shareholders of a controlled foreign corporation to tax no matter the type of income that CFC earns. The big change again with GILTI is the reduction of the Section 250 deduction from 50% to 40%. Additionally, the 10% qualified business asset sort of reduction to GILTI and from a computational perspective is no more. So we get rid of that 10% QBI, but we increase our indirect foreign tax credit from 80% to 90%. The result is an effective tax rate for U.S. corporations of 12.6%. And then if your foreign corporation pays tax, local jurisdiction tax of at least 14%, that should eliminate the U.S. Residual tax on GILTI or net CFC tested income. Next slide, please. FDII, the foreign derived intangible income deduction. Again, we're getting rid of the quote unquote intangible aspects here. Basically with FDII, the two changes were reducing the 250 deduction for qualifying income from 37.5 to 33.34%, so roughly 5% rate cut in the deduction. And likewise, there were changes to the types of income that were eligible for this deduction. A prime example is under Section 367 for an outbound transfer of intellectual property that would otherwise be a deemed gain recognition event, giving rise to an income inclusion. One, perhaps under the old rules that might be entitled to the FDII deduction. However, under the new OB3, for example, that getting a deduction for that specific type of gain recognition transaction is no longer available. BEAT, the base erosion anti-abuse tax. No need to spend a lot of time here on this, in particular because most companies who are subject to this tax are those you need 500 million of annual gross receipts or more. So you're a U.S. or multinational publicly traded company generally, but basically the 10.5% base erosion anti-abuse tax is going to apply to related party transactions that are really intended to lower your U.S. taxable income base. And there was an expanded CFC inclusion rule. The OB3 expanded the foreign corp's pro rata rules requiring a U.S. shareholder who owns stock directly or indirectly during any part of the CFC year to include their pro rata share of subpart F income. This was a change that eliminated the quote unquote last date of the CFC's taxable year inclusion date. In effect, the change is intended to basically subject more U.S. Shareholders to income tax and to prevent effectively games from being played. Last but not least, the Section 954C6 look-through rules for CFCs. Basically, the intent of the change that was implemented here was to enable greater flexibility in managing foreign-to-foreign cash flow within multinational groups without triggering immediate U.S. tax. In effect, for example, if you moved money from a foreign subsidiary to a foreign parent, there were perhaps or an affiliate, there were perhaps risks of dividend income, but this enables a wider sort of look-through exception, again, with the intent of creating for better flexibility with managing cash flow in a multinational group.
With that, I think I just want to thank everyone for joining us. Hopefully, you're going to learn something, and I'll turn it over to Aubrey. Thanks for bearing with us.
Thanks, guys. This concludes today's program. We would like to thank our speakers today, Alan Whitland and Robert Bergson, for an excellent presentation. Our next program will be Celebrity Estate Showdowns, Recent Celebrity Wealth Transfer Litigation Battles Unraveled. The program will take place on January 20th with Vacha Zetjian. Thank you so much for joining this afternoon. See you next time.